What is up everyone, welcome back to another stock market video. Today I'm going to be going over 3 stocks that I'm buying in July on the Sharesies platform. Now, so therefore these are going to be just New Zealand stock. If you're new here, welcome. My name is Gifford. I've been documenting my stock market journey for the last 2 months on the Sharesies, Hatch and Investnow. I'm new to stock trading and I'm just showing you what I'm doing, so please do your own research. I may end up losing money and I don't want you to lose money too. So with that said, let's go have a look at the computer. So here's my stock portfolio here on Excel. I've just made this so it's easier to see. I usually use Site, but because I use the free version, I can't put my Sharesies and Hatch on there as well. But as you can see, I've got $7,200. So the way I've done my portfolio here is about 70% is in mutual funds and index funds, and 30% is in individual companies through Sharesies and Hatch. So I'm pretty happy with the milestone of $7,000. So I'm just going to keep putting more money into it. As I say, I've been trying to put at least $150 into it every week, but sometimes it's not possible, but I put in what I can. So over here in Sharesies, it's quite a small portfolio value of $622.80. So as you can see on my Sharesies account, I've now only got 4 stocks, and that's just because I've sold out of my other ones, which I think I had Z Energy, I sold out of EBOS Group, and also ANZ, my bank stocks. And that's just because it's a lot easier for me to keep a track of these ones here, and these retirement villages and restaurant brands are all pretty safe. So I'm just going to buy these safer companies here over in Sharesies while I buy higher, riskier stocks over on the Hatch portfolio. The Sharesies really just complements my ETFs and index funds in my Investnow account. So what did I buy retirement village stocks? And mainly this is to complement my safer stocks, safer slow growing stocks over time. We know that in New Zealand, people are getting older, and also the generation coming up now that are likely to go into these retirement villages will be the baby boomers. So retirement villages stocks are going to be pretty predictable. They're not like growth stocks and tech stocks. So I've got 122 stocks in Oceana, and we can see there I've got a $40 limit buy on there already. And looking from the graph, we can see that the price was hovering around about $1.30 and then came the March lows. And then it slowly climbed up and it's kind of bottomed out into here, and we can see where I've started accumulating it here. So I've got a price target of buying this around about 90 cents. And if we can go about 1 year, we can see that they hover around the $1 mark. And then it really started to creep at the beginning of the year up to the $1.30. So this is where I kind of see them ending up. And that's why I'm buying these lower parts here, as then I wait for them to come back up again. Going over to Simply Wall Street, we can see here that Oceana Healthcare owns and operates various aged care centres and retirement villages in New Zealand. Now they've got here that the PE ratio is 9.8, which is good because I normally like to purchase anything under 20, and the earnings grew by 65% over the past year. Now there is a risk analysis here and it's minus 32%. So that's not very good. I'll have to have a look at what's going on there. So over at Yahoo Finance, we can see that the 52 range, they got it down as low as 38 cents and as high as $1.39. The market cap is 577 million, and they have a PE ratio of 9.69, as we said before, and also that they have a dividend of 5.21%. But as I've mentioned before, I'm not really after dividends. I have other ways of getting passive income. So going over to Simply Wall Street, they've given it a fair value of 86 cents, which is 9.7% overvalued. But my prediction for these guys is that they're going to go past to $1 to $1.10. So therefore, I think that's going to be an easy 10% gain over the next year or two. And in the financial health, we can see that the short-term liabilities are covered, but the long-term liabilities are not. So for the dividend investors again, it's just showing you here that they give out a 5% dividend, if that is what you're into. So being a new stock I'm buying into, I went to the Oceana Healthcare investors page. So just doing a little bit of light research into them. So wanting to know past performance, I found their last year's annual general meeting. So this document here was given out on the 29th of August 2019. So we can see from the slide here showing their financial highlights that in 2018, that their operating cash flow was $82 million, and that was increased to $89.3 million, so it's increasing. Also, their total assets grew as well from 2018 for $1.1 billion to $1.4 billion. So this slide here is quite interesting because they're wanting to create more premium villas and apartments. So from 2017, we can see that their standard beds have been slowly declining, and they're wanting to get that down to 18% since 2017, that they've been increasing their premium beds capacity with a target in mind of 30%. So that's going to bring in more money, more revenue. Right, a bit of rain. So moving on, in the last slide here, we can see the future developments coming up. So we just have to remember with the lockdown that this is all going to be delayed. But as I say, we are getting the company at a discount at 90 cents to previously what they were before at $1.30. So I think that's to be expected. And I can just see them slowly increasing that over time as they get through these here and get them built up and occupied. And the last thing before I move on from Oceana is that they are going to be releasing their full year results very shortly on the 23rd of July. So we should see the full repercussions of having to shut down during level 4 in those financials. So the second stock that I'm going to be buying, and I've talked about them before, is Ryman Healthcare. We see here that I've got 9 shares in them with $117 worth. So going to the graph, I've been buying them since May and all the way through June. So I'm going to be buying more over July, and my price target for these guys is $13. And having a look previously where they were, so they were about $16. So I'm just going to accumulate them, and I am hoping that they're probably going to go up back to this price again and hopefully exceed it. So I'm just going to continually keep buying. So over to Yahoo, we can see the 52-week range was at $6.61 at its low to $17.20 at its high. That the market cap is $6.5 billion and the PE ratio is at 24, so a little bit higher than my 20 target. And they also have a dividend of 1.95. So over at Simply Wall Street News, they've got an article here about insiders selling the stock, so that's pretty interesting. So reading this article is pretty concerning that an insider has sold his shares worth $25 million in the company. So the person selling it turned out to be Kevin Hickman. So he's one of the people that started Ryman Healthcare. As you can see, it's actually in its name. It wasn't completely bad news because it ended up only being 5.7% of its holding. So I'd imagine during these uncertain times, he's just trying to get his money out of here as opposed to something really going wrong with the company. So I'm not too worried at that. So back to Yahoo in the statistics tab, we can see that they're quite profitable at 62.5%. So usually I look for something over 25% is pretty good to me. So the last stock I'm buying is Somerset, and I currently got 18 shares in them and they're up by 6.8%. So we can see from the graph that I haven't really been buying the last couple of weeks. My price target for this is $6.50. So over to Yahoo, we can see the 52-week range is at $3.36 and the highest I got was $9.30. Their market cap is $1.5 billion, and also they have a pretty low PE ratio of 8.7%, and they do have again a dividend at 2.09. So another good stock for the dividend investors out there. So back to Simply Wall Street, we can see that they think that they're trading at 64% below the estimated value, which is quite a fair bit, and also their revenue is forecast to grow 10% over the next year. So one of the risks that are outlined here, that earnings is going to be decreasing by 8.2% over the next 3 years. So just back to Yahoo quickly, we can see that they have a massive profit margin of 114%, so that's quite interesting to see there. So the Simply Wall Street price valuation here is really bullish. They think it should be at about $18.72, but we know that the stock has never gone up that high. The highest it's ever gone up is $9.30, so this is quite interesting to see. So one of the things that concerns me about this company is that they are in a lot of debt. So as we can see here, they can't cover their short-term and long-term liabilities. And reading here, their debt to equity ratio is at 54%, and that's not overly high, but that is still pretty high. So lastly, just having a look at inside trading, we can see that there has been more buying than selling, so that's a good sign. So that's what I'm buying in the month of July, so I hope you found that interesting. If you're wanting to do some trading on Sharesies and Hatch, the referral codes will be after the video. Thank you for watching, and we'll see you on the next one. Goodbye.